Hello guys, welcome back to my YouTube channel. In this video, we will discuss the concept of dollar cost averaging and its application in building significant wealth over time. They combine this strategy with a specific trading approach to create a comprehensive wealth building strategy. Dollar cost averaging is explained as a method of investing where an individual consistently makes small, frequent contributions to their investments over time, regardless of market fluctuations. This approach aims to lower the average purchase price of assets over the long term. This is typically safer to apply dollar cost averaging to well-diversified funds such as indexes or ETF rather than individual stocks. The drawbacks of using dollar cost averaging on singular stocks are highlighted, as stocks can continue to decline for extended periods or even go bankrupt, potentially leading to substantial losses. The presenter's unique twist on dollar cost averaging involves applying it to major indexes, but only after a significant decline of at least 25% from the previous high. They provide an example using the Russell 2000 index to illustrate how this strategy works. By entering positions during market declines, investors can benefit from lower average purchase prices and better risk-reward ratios. The video also suggests using leverage, such as a 2-to-1 leverage ratio, to enhance returns further when applying dollar cost averaging to indexes. The goal is to achieve higher returns while keeping risk levels reasonable. Additionally, the application of dollar cost averaging in other asset classes, such as real estate, they show how the same principle can be used in property investment to purchase properties when prices are below a trend line, thereby minimizing risk and allowing for the use of leverage through mortgages. Comparisons are made between lump sum investments and dollar cost averaging. The video demonstrates that timing your investments during market declines can lead to similar or even better results with less drawdown and a shorter investment horizon. Applying leverage at lower risk points can substantially increase annualized returns. In conclusion, viewers are encouraged to be proactive with their investments, seeking discounted prices at lower risk points in the market. Combining dollar cost averaging with sensible leverage can significantly enhance returns over time. However, the importance of applying these strategies to well-diversified indexes or funds and avoiding singular stocks. The video provides valuable insights into how dollar cost averaging can be a powerful tool when used strategically. If you enjoyed this video, please like and subscribe to my YouTube channel for more videos.